Hello guys, stop. If you are preparing for FRM Part 2, you already know how hard it is to find proper question solutions, but not anymore. In this video, I will solve some of the trickiest and exam relevant questions with shortcuts you won't find anywhere online. So this is the part 2 of the 4 videos I'm making on the first chapter, the first reading on the estimating market measurement, introduction and overview. This is for the part 2 exam, FRM part 2, book 1, market risk measurement and management. So let's begin with solving the question. Yesterday we have completed 10 questions. Today we are starting with the 11th one. So Nelson is preparing a presentation on the attributes of value at risk. Which of the Nelson's following statement is not correct? So the focus word is not correct. We have to see which one is not correct. So option 1, var 10% is equal to 0 indicates a positive dollar value is likely to occur on 90 out of this is not correct. Actually what it means, it indicates that there is a 10% probability that on any given day the dollar loss will be greater than 0. So this is not the correct answer. Second, VAR can account for diversified holdings of financial institutions, reducing the capital. The VAR was designed not to reduce the capital but to calculate what will be the capital required. Third, VAR at 1% can be interpreted as the number of days that a loss in portfolio value will exceed 1%. Yes, this is exactly what it means. So a 1% value at risk means the number of days, okay, a portfolio value will exceed that value 1%. Still we'll go to the third option. VAR was developed in order to more closely represent the economic capital necessary to ensure the commercial bank solvency. So that was not for the solvency part. So we'll go with the third answer. Now let's go to the next question. Okay, now here if you read the question, it is asking you to compute VAR of bond portfolio at 95%. They have given you the price value basis of a portfolio of 20 million. So it says that for 1 basis change, there is a change of $25,000 in the value of the portfolio. And this is the table given to us, the probability table. So you just make it this way. We are always concerned. We always have to concern about this area. Okay. So the next 1 year. 1 year means they are long. Okay. Long means what? If there is an increase in the rate, so there will be a negative, the bond value will fall. Okay, so if we see this this is 50%, here you suppose 4%, this is 1%, and this is 5%. So the probability here is from 2 to 2.49. So we'll take 200 basis point change. So for 1 basis point there is a change of 25,000. So for 200 basis point, how much it will change? So you just multiply both, you will get the answer as D. Let's go to the second one. Okay. Okay, you calculate the VAR. Use the formula. Formula is equal to the portfolio value into minus mu plus z into the sigma volatility. So you have the market value, you place it here, 2 point, whether they have given a daily, this is the standard deviation, they have given us 1.7, and this corresponds to 97.5%, that z value will be 1.96. So you put the z value here. Mean is not given, not an issue. You calculate this, you get answer as 83966. So in these options we have one here and one another here. So we know that this is not the answer, this is not the answer. Now you read what is given. This one will exceed this amount. This one is the answer. Now let's go to the second one. They are asking you to calculate the VAR at 99. So at 99, what will be the z value? Z value will be 2.326. They have given the standard deviation as 0.08. They have given the portfolio value, and the expected return they have given the mu. So the formula for VAR is minus mu plus z into sigma, and then the portfolio value. So this is 0.06 minus plus 2.326 into sigma is 0.08, and you multiply with the portfolio of 100 million. What answer you will get? Calculate, take a pause. The answer is 12.6. Let's go to next question. This first chapter is basically on the VAR, and you should be very clear because already in part 1 we have studied how to calculate VAR. Okay, in this also, assuming the standard deviation, calculate the VAR. Okay, again we have to calculate the VAR. They have not given which type of VAR is to be calculated. We'll start with the formula. So the VAR is equal to portfolio value into minus mu plus z into sigma. Large bank currently have market value itna hai. We have market value of 145. The daily return on the is normally distributed with 80% of the distribution lying within 1.28 deviations above and below the mean. 90% of distribution lies, assuming the standard deviation is 1.2. So we'll take this. We don't have the mu here. We don't have. We'll take 1.012 into the z value for we have to 5%. That is 95 confidence, and that will come to 1.65. So into 1.65, and that will give the answer 2.87. This is garbage value, means it is not required for our calculation. This is just to confuse you. Okay, now moving forward. Again, this is a theory question. Which of the following statement for the value at risk is true? VAR increases longer holding. Yes, this will increase because you know VAR into root t. So as time increases, this whole value will increase. Okay, this is the answer. We don't have to read the other ones. Okay, now continuing with the question number 17. So here we have to calculate the portfolio VAR at 5%. So when it is given portfolio, this is a two-stock portfolio. We know that the A is 75,000, B is 25,000. So the weight here is 0.75 and weight here is 0.25. We have given the correlation value as 0.8. You know what to be done. We have to take the weight of A, 0.75, and the value you take the value as 75,000 square. Then you take B is 0.25, value is 25,000. Then the correlation is positive, so it is 2 into 0.75, 0.25, 25,000, 75,000 and 0.8, and this will be in under root. So you will get answer. See where we are going. We know that our what is VAR? VAR is equal to the portfolio value into the expected value plus the Z value, sigma, this R. So right now by calculating this, we are calculating the sigma. Okay, so once you solve this, you will get 13.33. so this 13.33 is your sigma value. Okay, so you just need to, okay, I don't have the option of cutting this part. Okay, no problem. This I'll put it here, point 0.1333. Z value, this it is 95%, so it will be 1.645. Now we have to calculate the expected value. How we are calculating the expected value? It is a simple mean. We have already given expected value here, so it will be 75,000 into 12% plus 25,000 into 10.8%, and this will give you as 0.7. This will put here minus. What is the portfolio value total? Is 1 lakh, and this will give you the answer. $10,295. This is the answer. Question number 18. Okay, now this is again the theory question. Nowadays the GARP is very much interested in checking the concept of the candidates. So they are now not checking the quantitative part, they are checking the qualitative part. So the expected loss, given that the loss has exceeded the VAR, is best described as exceeded. See, go here. If we say that this is the VAR, if it goes here, so it becomes the expected shortfall. This is the answer. Not to waste the time on this. Okay. Now we are on the 19th question. Again, we are trying to understand which one of the following is true regarding the VAR. So the VAR decreases with longer holding period? No. There was an earlier question in which we know that it is like this. Okay, as it will grow, or it will, as the holding period increases, it will not decrease. Yes, VAR increases with the lower significance level. Your Z value for 5%, your Z value for 2.5%, your Z value for 1%. What are the Z value? This is 1.645, 1.96, this is 2.33. So as your the significance level, it goes down, the Z value increases, so the VAR will increase. So this B is the answer. Coming to the last question for the day, the round up here. Then I will continue on the next. I'll put the link of my previous videos on this on the link above. So the question is that in the presence of fat tail in the distribution of the return for the linear portfolio, VAR based on the delta model method would. Okay, so we know that our VAR has this one, and it is asking that the presence of fat tail. So we have fat tail, it will go like this. Okay, I should have used another color, preferably this one. So fat tail means it will go like this. So now based on the delta normal method, this is the VAR. Okay, so this is not capturing this area. This area is not being captured, so there is a risk of this much, but our VAR model is telling that this shaded, black shaded is the VAR, so it is underestimating. That's why this is the answer. So thank you for watching. Please like and subscribe my channel. I am new to YouTube. I have already given my FRM Part II exam this November, and I am waiting for my results. During my journey for FRM, I found that the number of questions available is very less. Although you will get everything on Telegram, you will get the material, you will get the PDF, you will get the reading videos, but question solving, there are very few people giving, and they are charging. So I am doing this for free, but if you like and subscribe my channel, this will motivate me to continue with this. So thank you very much for watching. Bye.